Welcome to Name Confidential, episode number 40. I'm your host, Ben Fox, and today I have the pleasure of introducing our speaker, Dave Taucher. Dave Taucher was the Chief Investment Officer for RAV Financial Services, LLC from January 1995 to September 2016, where he and his team were responsible for $340 million. The company was then sold to Sequoia Financial Group in September 2016, where Dave stayed with Sequoia for 2 years as a senior portfolio strategist and member of the investment committee. He currently is the senior portfolio manager for Pistone Wealth Advisors in Pepper Peak, Ohio. So Dave, thank you for joining us today and sharing all of your knowledge.
Hey Ben, happy Friday.
You too, yeah. It's always good to know when I'm doing Name Confidential because it's always on a Friday. So definitely.
And for all you Yankees fans out there, go Guardians.
I'm sure there's a few watching.
Good luck
Well,
to both.
I'm going to get the PowerPoint up for us here. And then just to make sure, do you see this, Dave?
Yeah, I got it.
Perfect. So I'm going to start here with the Name Exposure Index. Name Exposure Index, we always cover in the beginning of the show. It represents the average exposure to the U.S. equity markets reported by all of our members. Dave, do you report to the Name Exposure Index?
Yeah, I do. I'm one of the members that reports every week. It's interesting. I'm right at 80, so I guess I'm right in the ballpark there.
So this is just the Dave Taucher Index then.
Yeah.
Well, perfect. Yeah, it was interesting to see. I always like looking at this each week to see how it's moving. One of the big things that I noticed was one of our members moved from, I mean, the biggest bear position we had last week was -75, and now we have a levered bear position this week back at 200. And I had seen -200 for most of this year, so it was interesting looking back and actually seeing that change. So, yeah. I always enjoy looking at this and just seeing the differences week by week and seeing some of the small changes. Do you use this for anything? Do you ever look at it? And if you do, how do you use it? How do you interpret it?
I just look at it and compare it to other sentiment indicators that I look at to see if there's similarities or if there's a divergence that would prompt me to dig deeper.
Definitely. What are some of the other sentiment indicators you like to look at?
I use the let me see. One of them is the CNN Fear Greed Index, which is
Okay.
worked pretty well for me. The not really sentiment, but the Chicago Fed National Financial Conditions Index. But the Fear Greed Index is enough for me to determine where if there's an emphasis on either extreme fear or extreme greed, which kind of tells you that there's too many people on one side. But the thing I've noticed about that, and it doesn't matter if you're looking at Investors Intelligence or AAI, I find that when people are greedy or we see things are overbought or there are more people that are positive than negative, that usually doesn't indicate that the market's about to turn. Where I find it's more useful is when everybody is negative, that is a more likely determination that the market's about to turn up.
Yeah, no, I like that. I can definitely see that and have seen it at least a little bit in some of the indicators that we use as well on the sediment side.
Oh, okay.
Well, perfect. Do you have anything else on the Name Exposure Index, or do you want to jump right into your presentation?
No, let's jump in.
All right.
I don't have all the answers, and there's things that I'm talented at, and there's things that I need help on. And one of the things is that I go through a weight of the evidence approach, which we'll get into in a minute. But I also use the services of a company called Hedgeye. Hedgeye was started, I believe, about 15 years ago, trying to bring hedge style investing to the masses. Started by a fellow named Keith McCullough. I've been a subscriber for 4 or 5 years. And it really helps me to understand the macroeconomic backdrop of the markets that I'm investing in. I'm not an economist. I don't claim to be. And when it's reported that the GDP was up or down a certain amount, or the jobs report was doing this or that, I really don't know how to equate all that into something that's going to be useful for me in making investment decisions. So Hedgeye gives me that backdrop I need for how to interpret all of the economic factors that come into play. And we'll talk a little bit more about that, but let's go to the next slide and look at weight of the evidence. And I know a lot of practitioners use this because, as everybody probably knows, there's no one single indicator that's going to be helpful to you and can be used in a vacuum without other indicators giving you some other indications of whether or not that's a true change. So there's, I look at price, breadth, and sentiment, and different timeframes also. But the weight of the evidence is a confluence of various indicators that helps to identify the backdrop of whether we're in a risk off or a risk on environment. And I won't go through all of these, but just a couple at the very top there. I've named it the Elder Weekly. A lot of this information come from stockcharts.com, which I'll be talking about as well. So I guess I'm doing a commercial for Hedgeye and stockcharts.com today. But the Elder Weekly was developed by Alexander Elder. A lot of people know that name. And it's a measure of strength and a momentum, and it looks at weekly prices of various indicators of the major market indexes to determine whether or not we're in a risk on or risk off environment. And the Elder Weekly does bar charts every week that are either red, green, or blue. Green is good, red is bad, and blue is be ready for a change in color. So this weight of the evidence I have on the screen right now is from last Saturday. I go through this exercise every Saturday morning to determine the weight of the evidence. And you can see there the Elder Weekly. I look at the S&P 500. I look at the equal weighted S&P 500, the Qs. I also look at, recently I've added the New York Stock Exchange. The reason for that is that when we look at the S&P 500, as everyone knows, the participation has become more and more narrow. So when I'm looking at that as an index, am I looking at 500 stocks? Or am I looking at the Mag 7? Or if I'm looking at the Mag 10, whatever the name is for that week? So I look at the New York Stock Exchange because it includes all of the issues on the New York Stock Exchange, the composite. So that was added on there about a month or so ago. IWM for representative of small cap. All 5 of those, all 6 of those were green last Saturday. And it was only the foreign ETF IXUS, which was blue. So if you look in the far right column, I either give it a plus or a minus or a neutral. And as you look down that far right column, pretty much everything is positive. So that just gives me, as of last Saturday, an indication that, generally speaking, we're in a risk-on environment. And I mentioned that there's both long and short-term indicators. If you look at the 4th one from the top, I'm looking at the New York Stock Exchange AD line, the advanced decline line, and applying a 21-day moving average to it. And that helps me. This is a short-term indicator. This is what I call my canary in the coal mine. If anything's turning negative, that's the first sign that I see when that turns negative, that's suggesting to me that I need to be more aware and looking at next intermediate and longer term signals to see if that is a new trend developing where the market is turning against me.
So are there a few that you give a little bit more weight to when you're looking at it, kind of like that one?
No, not necessarily. It's looking at everything collectively, although that would be an interesting study to see if you apply different weights to different indicators, if that would be helpful. But that's not an exercise that I've taken, and I don't know that I really want to take that exercise. I'm not sure.
What do you, how do
there.
you,
Yeah.
oh, sorry.
Yeah.
How do you look at this? Like, say you're seeing, a pretty even disbursement, if you've seen that. Like, how do you decide which way to go, risk on, risk off?
Yeah, that's where it becomes difficult. You're talking about essentially where there's not a clear weight of evidence, positive or negative. Is that essentially
Correct.
what you're asking? Yeah, well, then I look, I get back to looking at the charts, looking at price, to help me determine is this an inflection point where we're really looking at a change in the market regime from positive to negative or negative to positive. So once this goes to, let's call it neutral across the board, then I got to go to other places to look for some type of indication is that there's been a change in the primary trend. Because at the end of the day, that's really what I'm trying to capture, the primary trend up or down. Being a trend follower, that's primarily what I'm focused on. So I don't know if that answers your question or not.
No, I think it does.
Okay. A couple others on here, if you go down near the bottom, third one up from the bottom, the go, no go chart. Some people are familiar with Tyler Wood. I think well, I know he's a chartered market technician, but he's also, I think he's a member of NAAIM. But he and his partner have a pretty cool website where they use various indicators to give you a go or no go on SPY or on any individual stocks. And you can look a little bit more about this on if you just Googled go no go charts. I'm sure you'll find something on it. So I steal from a lot of people to get additional information because once again, I don't have all the answers. So I use the go no go charts to help me along. IBD, the Investors Business Daily, I use that extensively. They on a weekly basis have ratings on stocks where depending on their proprietary indicators, whether or not you should be 80 to 100% in stocks, 0 to 20%, or anything in between. And then finally, I mentioned Hedgeye previously. We see here Hedgeye quad, we're in quad 3. What does that mean? Well, I guess we can move to the next chart because that's a good segue to what I look at from Hedgeye. So once again, hedgeye.com provides hedge fund quality research for everyday investors like me, and they also have institutional clients. But like I said, they give me the macroeconomic data to help me determine what regime we are in. And they look at a number of factors, the primary being number one, Fed policy and inflation and economic growth, whether it's rising or falling. And depending on the confluence of those three factors, they arrive at what quad are we in. They have 4 different quads that they identify. Quad 1 is Goldilocks. That's where inflation is dropping, growth is rising, and Fed policy is easing. Quad 2 is reflation. Quad 3, which we just looked at, is stagflation. So they're suggesting that growth is slowing, economic growth is slowing, and inflation is rising. They don't look at specific levels, they look at rate of change. So right now they're saying quad 3 is stagflation, quad 4 deflation. That's the worst quad you can be in. And depending on which quad we're in, if we're in quad 3, they identify certain sectors, styles, and asset classes that work or don't work in each of those quads. So right now in quad 3, the areas that they suggest will work in quad 3 are gold. How about that? Gold at all-time highs. Commodities, utilities, energy, tech, staples, healthcare, and fixed income. And right now, being in quad 3, I can take that and match it up with other things that I'm seeing from these other sources that I'm looking at, the weight of the evidence, and stockcharts.com, which I'll get to in a minute.
How often do they update their data?
The data is updated daily, but you don't see changes in the change in the quads don't occur in short-term timeframes usually. So they actually can identify when we're starting to make a transition from one quad to another. And just recently, this quad 3, they saw that transition coming over the last couple of months, but now they suggest that we're firmly in quad 3 stagflation. So it remains to be seen what future growth, the GDP numbers look like going forward, and inflation. And if they're right, they're suggesting that inflation is going up and growth is starting to slow.
So they'll put in there like something like, hey, like this is where we are right now, but we might be moving towards this in the future kind of thing.
Correct. And they do this exercise not only on the US, but on every major country in the world that has a stock market. So they will also, and me being a trend follower, I'm a go anywhere investor. So I'm not only looking at the US and Europe, I'm looking at markets all over the world. And Hedgeye helps me to identify what quads other countries are in. And interestingly enough, quad 1, which is the best, the Goldilocks quad, they identify China transitioning to that quad for what it's worth. And obviously, we've seen a lot of action in China based on stimulus news and what have you. So that's kind of interesting.
I'm gonna have to check that out. That is interesting.
Yeah. So, I mean, right now, my clients are invested in India. We've been in India for about since early summer, and just recently in Malaysia. So those are not usually two ETFs that a lot of advisors find themselves in. I think we can go to the next slide, Ben. So we're based on everything that we're looking at now, what we see is rising interest rates over the last month, and about the same time frame, rising US dollar. That has a tendency to have an impact on the market overall, and certainly with rising interest rates. I mentioned REITs and utilities, which we are invested in, are at the top of the list, but they've been a little under pressure lately because of rising rates, because those are two sectors that are rate sensitive. Now, we're still in both of those. We'll see how interest rates go moving forward, but those are still in a positive regime for us, so we're sticking with those. The other interesting thing we see is a rise in interest in nuclear power. So you're looking at uranium. That's been a big move in the last month. I don't know that we want to jump on that train right now, but it's becoming interesting. And that's tied in with the next bullet point about energy and utilities. These data centers, it's well known that they need high levels of energy. And I think it was a couple of weeks ago, Microsoft announced a deal with Constellation Energy to restart one of the 3 Mile Island nuclear reactors sometime in late 25 or early 26 to provide Microsoft with energy for their data centers. So just something that we have to be aware of. Gold at all-time highs, and the Inflation Reduction Act, I'm starting to see it affecting price in areas of infrastructure and industrials, which have been doing pretty well. And I think we'll see going forward, downturn in commercial real estate may be slowing or ending as interest rates come down. So that plays well into investment for REITs.
Perfect. So based on what you're seeing right now, what do you think going forward? What are your thoughts going forward with the market?
Well, I mean, one of the things that we have to be aware of, a couple things, seasonality, first of all. I mean, when you look historically at the market, November through May are the typically the strong months for the market. Against that, the headwinds we're dealing with, and we can't tell how those are going to play from a timing standpoint. I mean, in the US, we're dealing with record deficits and debt. It borders on ridiculous, and there's no end in sight. What's the end game there? I have no idea how that will end up impacting the financial markets at all, but it's something to be very aware of, not only as an investor, but also as an American.
Right.
And finally, valuations. I think the S&P is right around 22 PE. Everyone knows pretty much you can't time the market based on valuations, but a number of studies, when you look at capital markets historically, starting from levels where we're at now, the returns going forward, when you look over the next 5 to 10 years, historically have been in single digits. So at at some point, we're going to have to lower our expectations for what we think that the market can deliver, and that we might not be seeing double-digit returns going forward.
It's definitely going to be interesting, especially with everything on the horizon, the other Fed meetings, the election, all this. It's a fun year.
Yeah, yeah. All right, let's go to the next slide, Ben.
Perfect.
I mentioned stockcharts.com, so I'll do my commercial for them. I tell you what, I mean, I've used them for many, many years. It's so affordable, and it's got so many tools that are useful, I think, to professional investors, amateurs, and everything in between. But where I get some of my ideas is they have a scan library, and you can create your own scans by asking, show me all the stocks with a certain dividend, earnings per share, new highs, new lows, and create those. But Stock Charts has put together a huge library of scans that you can automatically press a button and show me, all the stocks that are showing a positive MACD crossover, show me all the stocks that are hitting all-time highs, or new 1, 3, 6, 9-month highs, or relative strength, stocks that are outperforming the S&P 500 over a certain time frame. As you can tell, being a trend follower, I want to see stocks are in strong uptrends. That's important to me to look at, as well as I look at, some people may be aware of stockcharts.com has relative rotation graphs, which helps me to identify relative strength and momentum, not only of the sectors, but of individual stocks. And that's a very important tool that I use as well. I think we got one more slide. We might have two, but one of the other things I looked at, stockcharts.com has a great sector analysis tool. If you look at this screenshot here, it was from a few days ago, the major sectors of the S&P 500. And on the second column from the right, you'll notice a column that's color-coded. It's titled SCTR, which stands for Stock Charts Technical Ranking. They call it Scooter for short. So they have their own proprietary ranking on technical analysis of each of the sectors. And the numbers run from 1 to 99, with 99 being the highest. And you can see the 4 in green there. Utilities, financials, and real estate and industrials. You got to argue that these have been pretty strong performers in recent weeks and months. So here again, getting information from many different sources so you can come up with conclusions as to what areas of the market you're going to invest in. So
have you ever seen anything reach 99 on there?
Not recently, but I think utilities are pretty darn close there, 98.4. So we've been in utilities for the last couple of months. It's worked out very well for us. I just got into industrials about 2-3 weeks ago. And I think we've got one more chart, Ben, and one more slide. I mentioned Investors Business Daily. I use this quite extensively. Every day they have a daily list of stocks on the move. So every day I want to look at any stocks that are up or down in price on unusually high volume. That just represents a source for further study. And for those that know, Investors Business Daily rates all the stocks on a composite rating of 1 to 99, just like the previous slide, with 99 being the strongest. It's their proprietary study on an individual stock, earnings per share, relative price strength, group relative price strength, and whether the stock's being accumulated or distributed. And finally, their stock lists give me a list of stocks with relative strength lines hitting new highs. Again, being a tip trend indicator, I want to see stocks that are exhibiting strong relative strength to give me ideas as to where I can invest. I think that kind of wraps up what I wanted to cover. A couple things I think is important. As a business, it's important for all of us to understand that it's all about transparency, accountability, and trust in dealing with clients. So that's kind of a guiding light for us in dealing with clients and making decisions.
No, definitely. And I know a big thing at NAAIM is we're really big on sharing resources and knowledge, and you had a lot of stuff a lot of different resources that you shared today. So if anybody wants to reach you, you have your contact information up here.
Sure.
I know you won't be able to make it to the Outlook conference, but you do go to UK next year, right? You'll be at that conference.
I love those. I mean, I tell people, I think I've been a NAIM member for 12 years or so. And I tell people I've been in business 40 plus years, and you learn, you're constantly learning. But when I joined NAIM, that just accelerated significantly. It helped me to look at things differently. And I probably learned more in NAIM in the first few years than I did in the prior 20. And I mean that. It caused me to look at things differently. And it's been a very valuable organization.
Definitely. Well, it's good to hear that from another person. We hear that a lot, but every person who says it keeps confirming it for us.
Yeah.
Do you have any other thoughts, or do you think you've shared most of it today?
No, I think that covers it. I mean, distill 40 years of history into 30 minutes. So there
Well,
might be
definitely.
more things, but that's all I got to cover today.
Well, thank you so much for joining us on Name Confidential and sharing your knowledge. And we hope to see you again, but
Yeah,
we'll wrap up today's show and hope to catch everybody next week at next week's episode.
sure.
Thank
Thank
you.
you, Ben. Appreciate your time.
You too. Thank you.
Take care. Bye now.
Bye.